February 11th, 2026, 11:23 a.m., Greenwich Mean Time. I'm looking at data that 3 months ago would have gotten you laughed out of every economics department in the Western world. The British pound just flash crashed to 1.840 against the dollar before recovering to $1.0920 in 14 minutes. A 73 pip move in less than a quarter hour during London trading hours with no corresponding geopolitical event, no central bank announcement, no data release. The financial press is calling it algorithmic volatility. I'm calling it the controlled demolition of a currency that has been the foundation of global finance for 300 years. And the demolition crew? The same offshore dollar funding desks that have been engineering liquidity crises since Lehman Brothers to extract wealth from sovereign nations, while the IMF pretends to offer rescue packages. This isn't market dynamics. This is financial warfare. And the weapon is the Eurodollar system that nobody understands and everyone depends on. Let me show you the architecture of the trap before they spring it completely. Before we go further, the legal departments of Consensus Reality want me to tell you this is not financial advice. Perfect, because advice implies the system is designed to serve your interests. This is a structural analysis for people who've noticed that every currency crisis in the past 40 years has followed the same pattern. This is threat intelligence for anyone who has watched their purchasing power evaporate while central bankers insist inflation is under control. This is pattern documentation. For those who understand that when the pound sterling collapses, it's not the beginning of the crisis, it's the middle. Do your own research if you still trust the people who told you Brexit wouldn't matter and quantitative easing was temporary. I'm here to decode what the cross-border payment flows are screaming before the suppression algorithms bury this analysis. Hit that like button right now. YouTube's content distribution systems in 2026 are specifically calibrated to throttle financial content that questions monetary stability. Every tells the machine this information matters to real people. Every share is a distribution node in a decentralized truth network. They want this video to flatline at 500 views while celebrity gossip gets 15 million. Prove them wrong. Click it. Let's get into the mechanics. The timestamp matters more than you think. 11:23 a.m. GMT is exactly when the London Forex desks are at peak activity and New York is still 3 hours from opening. This is when liquidity should be deepest, when spreads should be tightest, when a major currency pair like GBP USD should be most stable. Instead, we got a move that would normally require a central bank intervention or a geopolitical shock. But there was no shock. Sterling was trading normally at $1.0920, consolidated range, standard volume. Then at 11:23:17 a.m., someone dumped 8.4 billion pounds across 4 liquidity pools simultaneously. Not sequentially, simultaneously. The price dropped 73 pips in 47 seconds. Then, just as suddenly, the selling stopped. The price recovered 51 pips in the next 6 minutes. By 11:37 a.m., it was back to 1.108 like nothing happened. Except something did happen. Someone just tested the structural integrity of the pound and found it wanting. Let me show you the volume signature, because this is where the coordination becomes undeniable. During that 14-minute window, GBP USD traded $127 billion in notional value. The 5-day average for the same time window is $31 billion, 4 times normal volume, concentrated in a vertical price dislocation followed by an equally vertical recovery. Now, you need to understand what this pattern represents in the offshore dollar funding architecture. When you see simultaneous selling across multiple venues with immediate price recovery, you're not looking at directional speculation. You're looking at a liquidity stress test. Someone with access to cross-border payment infrastructure wanted to know exactly how much selling pressure it takes to break the pound below 1.09, and they got their answer, 8.4 billion pounds. That number is now recorded in every algorithmic risk model on the planet. The next test will use 10 billion, and the test after that won't be a test. Here's what the mainstream analysis won't tell you. The pound didn't flash crash because of weak UK fundamentals or profit-taking after a rally. It flash crashed because the Eurodollar system is imploding, and the pound is the canary in the coal mine. Let me explain the Eurodollar problem, because this is the mechanism that is going to take down the entire post-1971 monetary order. Eurodollars are US dollar-denominated deposits held in banks outside the United States. They're not regulated by the Federal Reserve. They're not backed by FDIC insurance. They're not subject to reserve requirements. They're offshore dollars that exist in a parallel banking system that's larger than the domestic US banking system. Estimates put the Eurodollar market at between 57 trillion and 90 trillion, depending on how you count the derivatives. That's 4 to 6 times US GDP existing as dollar claims outside Fed jurisdiction. Now here's the problem. Those Eurodollars were created through credit expansion by foreign banks making dollar-denominated loans without actually having the dollars. They assumed they could always access dollars through the swap markets or the Fed's liquidity windows if they needed them. But what happens when the Fed tightens and dollar liquidity dries up? What happens when the offshore banks that created trillions in synthetic dollars suddenly need actual dollars to meet redemptions or margin calls? They have to buy dollars. They have to sell everything else. Pounds, euros, yen, gold, equities, bonds, everything gets liquidated to obtain the dollars they need to stay solvent. And when that selling accelerates, you get flash crashes. Not in one market, in every market, sequentially. Starting with the most vulnerable currencies and moving up the food chain until the dollar itself breaks. The pound flash crashed today because UK banks are sitting on $4.7 trillion in Eurodollar liabilities, according to the Bank for International Settlements data from Q4 2025. That's liabilities denominated in a currency they don't control, issued by a central bank that isn't obligated to rescue them. When those liabilities come due and the counterparties demand actual dollars instead of rolling the credit forward, the UK banks have to sell pounds to buy dollars. Massive selling pressure. Price collapses. And today's 73 pip flash crash was just the preview. The real liquidation hasn't started yet, but it's coming. And the structural evidence is everywhere if you know where to look. Let me show you what happened in the gilt market simultaneously, because this is where the systemic stress becomes visible. At 11:24 a.m., 1 minute after the pound flash crashed, UK 10-year gilt yields spiked 11 basis points in 3 minutes, from 4.23% to 4.34%. For context, an 11 basis point move in 3 minutes is what you'd expect during a surprise rate hike or a failed bond auction. But there was no news, no auction. Just sudden, violent selling in the government bond market happening in perfect synchronization with the currency collapse. This is the signature of a forced liquidation. An entity or a group of entities had to sell both gilts and pounds simultaneously to raise dollars. They weren't selling because they thought UK assets were overvalued. They were selling because they had a dollar funding problem and UK assets were the most liquid collateral they could dump. Now let's talk about who these entities are, because this matters. The largest holders of gilt positions outside the UK government are Japanese megabanks, European universal banks, and Chinese state institutions. All three groups are drowning in Eurodollar liabilities right now. Japan's banking system has $18.3 trillion in foreign currency liabilities, 80% denominated in dollars. European banks have $31 trillion. Chinese banks have approximately $9 trillion, though the real number is probably higher because of off-balance sheet exposure through Hong Kong subsidiaries. When these banks need dollars, they can't just print them. They have to buy them. And to buy dollars, they have to sell assets. And the most liquid, highest quality assets they hold are U.S. treasuries and developed market sovereign bonds like gilts. So when you see gilts and pounds selling off in tandem with no fundamental catalyst, you're watching the early stages of a Eurodollar funding crisis that will eventually consume every fiat currency on Earth. Here's the timeline they don't want you to see. On February 3rd, 2026, the yen dropped 340 pips in a single session. On February 19th, the euro flash crashed 98 pips in 11 minutes. On March 1st, the Swiss franc, the supposed safe haven, dropped 127 pips in 20 minutes during Asian trading hours. And today, March 15th, the pound. 4 major currencies, 4 violent dislocations, 6 weeks. This isn't coincidence. This is a sequential liquidation pattern working its way through the G10 currencies as the Eurodollar system contracts. Each flash crash is a bank or consortium of banks scrambling for dollars. Each recovery is a temporary stabilization as they secure short-term funding. But the intervals between crashes are shortening. February 3rd to February 19th was 16 days. February 19th to March 1st was 10 days. March 1st to today was 14 days. The system is oscillating, and oscillating systems eventually break. Let me explain the feedback loop, because this is why the crisis is self-reinforcing and inevitable. When offshore banks need dollars, they sell foreign assets. Selling foreign assets pushes down foreign currency values. Lower foreign currency values mean foreign dollar-denominated debt becomes more expensive in local currency terms. More expensive debt means more entities default or seek to repay early. Early repayment requires buying more dollars. More dollar demand means more foreign asset selling. The loop accelerates. And the only way to break the loop is either the Fed prints enough dollars to satisfy global demand, which destroys the dollar's value, or the Eurodollar system collapses, which destroys the global financial system. There is no third option. The math is binary, and we're watching the collapse option play out in real time. Now, let's talk about what the Bank of England did immediately after the flash crash, because this reveals desperation. At 11:41 a.m., 18 minutes after the initial crash, the BOE issued a statement saying they were monitoring market conditions and stood ready to provide liquidity as needed. Standard central bank language, meaningless reassurance. But here's what matters. At 12:03 p.m., the BOE activated a $15 billion repo facility for primary dealers. They injected $15 billion into the banking system in exchange for gilt collateral. Why? Because the banks that got caught on the wrong side of the flash crash needed immediate liquidity to meet margin calls. The BOE didn't announce this publicly. It showed up in the overnight repo data released 4 hours later. They tried to quietly backstop the system, but the data leaked. And now we know the flash crash wasn't just a market event. It was a solvency event that required central bank intervention to prevent a cascade. Here's the problem with BOE intervention. Those $15 billion in repo loans are denominated in pounds, but the banks don't need pounds. They need dollars. So the BOE providing pound liquidity doesn't solve the dollar funding crisis. It just delays it. The banks will take the pounds, swap them for dollars through the FX swap market, and use those dollars to meet their Eurodollar obligations. But FX swaps have a cost. The dollar basis swap spread, which measures the cost of converting pounds to dollars, widened from 42 basis points yesterday to 68 basis points today. That 26 basis point widening means it's getting more expensive to obtain dollars using pounds as collateral. And when the cost of dollar funding rises, more entities can't afford it. More defaults, more forced liquidations. The spiral tightens. Let me show you what's happening in the currency swap markets, because this is the plumbing that determines whether the system survives the next 6 months. The dollar basis swap spread for GBP USD is now at levels last seen during the March 2020 COVID panic and the September 2008 Lehman crisis. At 68 basis points, it means you're paying 0.68% annual premium to borrow dollars using pounds as collateral. That might not sound like much, but when you're rolling over billions in short-term funding every day, 68 basis points is the difference between profit and insolvency. And it's not just the pound. The EUR USD basis swap is at 51 basis points. JPY USD is at 73 basis points. Every major currency is trading at a premium to access dollars, which means global dollar shortage is here, not theoretical, not coming, here, now, today. Now, let's talk about what this means for the average person, because I'm not doing this for academic exercise. When the Eurodollar system collapses, it doesn't just affect banks and hedge funds. It affects everyone who depends on the international banking system for trade finance, supply chains, and currency stability. Let me walk through the cascade. UK importers need to buy goods from abroad. Those goods are priced in dollars. To buy dollars, they need to sell pounds, but the pound is collapsing, so they need to sell more pounds to get the same amount of dollars. Import costs spike. Consumer prices rise. Inflation accelerates. The Bank of England has two choices. They can raise interest rates to defend the currency, which crashes the economy. Or they can print more pounds to support the economy, which crashes the currency. Either way, purchasing power gets destroyed. Your savings get destroyed, your wages get destroyed. And the people who saw this coming and positioned accordingly are the only ones who survive. Here's the geopolitical dimension that makes this even more urgent. The BRICS nations have been building an alternative payment system specifically to bypass the Eurodollar architecture. The mBridge platform launched in beta in January 2025, went fully operational in November 2025, and is now processing $47 billion per month in cross-border settlements. That's trade happening outside the dollar system. China, Russia, India, Brazil, South Africa, UAE, Saudi Arabia, Iran, all settling oil, grain, manufactured goods, and commodities in a gold-backed multilateral currency unit that doesn't touch the Eurodollar markets. Every transaction on mBridge is one less transaction supporting Eurodollar demand. And as Eurodollar demand falls, the offshore banks holding Eurodollar liabilities face a collateral problem. Less demand means lower dollar value. Lower dollar value means their liabilities become harder to service. Harder to service means more liquidations. The flash crashes we're seeing aren't random. They're the symptom of a monetary system being displaced by a competitor network. Let me show you the oil settlement data, because this is the canary that's been dead for 6 months and nobody noticed. In September 2025, 89% of global oil transactions were settled in dollars. By December 2025, it was 81%. By February 2026, it was 73%. In 5 months, the dollar's share of oil settlement dropped 16 percentage points. Where did those transactions go? To mBridge and bilateral currency swaps arranged outside the SWIFT system. Saudi Arabia is now accepting yuan for oil sales to China. Russia is accepting rupees for oil sales to India. UAE is accepting gold-backed trade credits for oil sales to BRICS members. The petrodollar system that Henry Kissinger negotiated in 1974 is dying. And when the petrodollar dies, Eurodollar demand collapses. And when Eurodollar demand collapses, every offshore bank holding dollar liabilities faces insolvency. And when those banks face insolvency, they liquidate everything. And that's what we're watching. The pound flash crash is just one frame in a movie that ends with the entire Western financial architecture in ruins. Now, let me talk about the timeline, because people always ask when this ends. I don't have a date. No one does. But I can show you the sequence. First, the flash crashes become more frequent and more severe. We're here now. Currency dislocations that used to happen once a year are happening once a week. Second, a major bank fails because it can't meet a dollar margin call. That bank will probably be European, probably French or Italian, probably within the next 90 days. Third, the ECB intervenes with emergency dollar swap lines from the Federal Reserve. That buys them maybe 6 weeks. Fourth, the swap lines prove insufficient because the Eurodollar hole is too big. Fifth, a G7 currency breaks its peg or trading band. My money's on the yen or the euro, probably the yen. Sixth, global trade finance seizes up because nobody trusts counterparty risk. Seventh, supply chains collapse. Eighth, governments impose capital controls. Ninth, cash becomes worthless. 10th, the people who prepared survive and everyone else learns a lesson that costs them everything they own. We're currently between stage 1 and stage 2. The flash crashes are accelerating. The bank failure is coming. I'd estimate 60 to 90 days before a major institution announces it cannot meet obligations. When that happens, the derivative contracts tied to that institution will trigger cross-default clauses across the entire banking network. Lehman Brothers took down $600 billion in counterparty exposure in 2008. The next failure will take down $6 trillion because the system is 10 times more leveraged now than it was then. And the central banks don't have the political capital or the balance sheet capacity to bail out $6 trillion in losses. So they'll let it burn. They'll implement bail-ins where depositors take the loss. They'll freeze accounts. They'll restrict withdrawals. And if you're still holding your wealth in a bank denominated in a collapsing fiat currency, you'll watch it evaporate while they tell you it's for financial stability. Let me show you what the smart money is doing, because this tells you everything you need to know. Central banks added 1,037 metric tons of gold to reserves in 2024. In 2025, they added 1,183 tons. In the first 2 months of 2026, they've already added 287 tons. That's an accelerating accumulation rate. Who's buying? China, Russia, India, Poland, Singapore, UAE. Who's selling? The UK sold 11 tons in January. The US hasn't sold any because the US allegedly has 8,133 tons, though the last real audit was in 1953, and nobody actually believes that number anymore. But the point is, the central banks in countries that understand the dollar is dying are converting dollars into gold as fast as they can without crashing the market. Meanwhile, Western central banks are pretending everything is fine while their currencies lose 8% purchasing power annually. Let's talk about the legal implications, because this matters when the investigations start. Currency manipulation is illegal under international agreements, including the G20 commitments and IMF Article 4 obligations. The penalties include sanctions, exclusion from international payment systems, and asset seizures. But here's the reality. When the entity doing the manipulation is a systemically important bank with $3 trillion in derivative exposure, nobody prosecutes, because prosecution means collapse. So they fine them a few $100 million and move on. Deutsche Bank got fined $2.5 billion for Forex manipulation in 2015. They're still operating. HSBC got fined for money laundering, sanctions violations, and market manipulation at least 5 times since 2012. Still operating. The system can't function without these banks. So the crimes continue with regulatory approval because the alternative is systemic failure. But here's what's different now. The Eurodollar crisis isn't something they can fine away. This isn't rogue traders spoofing markets. This is a structural insolvency in the foundation of global finance. No amount of regulatory forbearance can fix the fact that there are $70 trillion in Eurodollar liabilities and maybe $15 trillion in actual dollars available to cover them. The math doesn't work. And when the math doesn't work, the system breaks. No central bank can print enough to fill a $55 trillion hole without destroying the currency as value. No regulator can forbear away the fact that offshore banks owe dollars they don't have. The crisis is inevitable. The only question is how long they can delay it with coordinated interventions and how much wealth they can extract from the public before the collapse becomes undeniable. Subscribe to this channel immediately. We are documenting the collapse of the post-Bretton Woods monetary system in real time. This is the most important financial story in 300 years, and the mainstream media is covering celebrity divorces while currencies disintegrate. Hit the bell icon. Turn on all notifications. Make sure you're following our secondary archive channel linked in the description. We're distributing this analysis across multiple platforms because YouTube's suppression algorithms are actively throttling content that threatens monetary orthodoxy. Every subscriber is a node in a decentralized information network. Every share bypasses the gatekeepers. Do it now. Let me address the counter-argument because I know what the skeptics will say. They'll say the pound flash crashed because of a fat finger trade or a stop-loss cascade or seasonal low liquidity. They'll say, I'm seeing patterns that don't exist. They'll say central banks have unlimited tools to manage crises. And to those people, I say, show me the fat finger trade that executes across 4 separate liquidity pools in the same millisecond. Show me the stop-loss cascade that reverses itself in 6 minutes with no fundamental change. Show me the central bank tool that can create $70 trillion in actual dollars to cover Eurodollar liabilities without hyperinflation. You can't, because it doesn't exist. The evidence is overwhelming. The mechanism is documented. The crisis is unfolding exactly as the structural analysis predicted. The only question is whether you're willing to see it. Now, let me show you the historical precedent because this has happened before. In 1931, the British pound was the global reserve currency. Sterling was backed by gold. The Bank of England managed the system. Then the credit expansion of the 1920s created more sterling liabilities than gold reserves could cover. When creditors demanded gold instead of paper, the BOE couldn't deliver. On September 21st, 1931, Britain abandoned the gold standard. The pound collapsed 30% in 6 months. Every country holding sterling reserves got destroyed. The global monetary system fractured. Trade collapsed. Depression deepened. The crisis didn't end until World War II restructured the entire global order. We are in 1931 right now. The Eurodollar system is the new gold standard. The offshore banks have created more dollar liabilities than actual dollars exist. And when creditors demand actual dollars instead of synthetic Eurodollars, the system will collapse just like sterling collapsed in 1931. The pattern is identical. The outcome will be identical. The only difference is the scale. In 1931, global finance was measured in billions. Today it's measured in trillions. The collapse will be proportionally larger. Here's what I need you to understand. The currency you're paid in, the savings account you trust, the pension fund that's supposed to fund your retirement, all of it is denominated in fiat currencies backed by nothing except the promise that central banks will maintain value. But central banks can't maintain value when the underlying system is insolvent. The Bank of England can't defend the pound when UK banks owe $4.7 trillion in Eurodollars they don't have. The European Central Bank can't defend the euro when European banks owe $31 trillion. The Federal Reserve can't defend the dollar when the entire world is trying to exit dollar exposure simultaneously. The math is absolute. The insolvency is structural, and the collapse is inevitable. Tell me what you're seeing in your local economy. Are import prices rising? Are currency exchange spreads widening? Are banks restricting international transfers? Drop it in the comments. This is distributed intelligence gathering that matters. The official statistics are manipulated. The media narrative is controlled. But the crowdsourced field reports from real people in real economies tell the truth. Comment below. Let's map the crisis in real time. Here's my final warning, and I need you to hear this clearly. Fiat currency is not money. It's a claim on money that only has value as long as everyone agrees to accept it. The moment confidence breaks, the value evaporates. We are watching confidence break in real time. The pound flash crash wasn't a technical glitch. It was a crisis of confidence. Entities that previously accepted pounds demanded dollars instead. And when enough entities make that same decision simultaneously, the pound becomes worthless. Not eventually. Immediately. And this will happen to every fiat currency in sequence. The yen, the euro, the yuan, and eventually the dollar itself. The timeline is compressing. The flash crashes are accelerating. The Eurodollar system is imploding. And the people who understand this are converting paper claims into hard assets while paper is still accepted. The conversion window is closing, not when the next flash crash happens, not when the bank fails, not when the government announces capital controls. Now, while currency exchanges are still functioning, while gold dealers still have inventory, while international wire transfers still clear, this is the exit, this is the moment. And if you wait until everyone else sees it, the exits will be jammed and the metal will be gone and the conversion spreads will be 30% and you'll be stuck holding depreciating paper with no way out. If this analysis provided value, hit the super thanks button below. I spend 70-hour weeks building financial models and analyzing cross-border payment flows while mainstream analysts copy central bank press releases. I do this because someone has to document what's actually happening. Someone has to decode the data they don't want you to understand. Support independent research. Support the mission. Let's keep fighting the information war. One more thing. The establishment will call this fear-mongering. They'll say, I'm predicting doom that never comes. They'll point to past predictions that didn't materialize on the exact timeline forecasted. And they'll use that to discredit structural analysis. But here's what they won't tell you. The 2008 financial crisis was predicted by analysts who understood mortgage-backed security fraud in 2005. They were called crazy for 3 years. Then they were called right. The Eurodollar crisis has been building since 2018. The analysts who understood the math have been warning for 8 years. We've been called conspiracy theorists, doomers, permabears, and we've been right about the direction while being uncertain about the exact timing. Because complex systems don't collapse on schedule. They collapse when a critical threshold is breached. And we just watched the pound breach a critical threshold. The next breach will be bigger, and the one after that will be terminal. March 15th, 2026, 11:23 a.m. Greenwich Mean Time. The pound flash crashed and recovered. But something broke that didn't unbreak. The confidence is gone. The credibility is shattered. The Eurodollar system is bleeding out, and no central bank intervention can stop the math. The timeline is compressing. The crashes are accelerating. The end game is here. Hold hard assets. Watch the basis swaps. The system is fracturing. We're not done.